Today, we're diving into a topic that often trips up traders as they get deeper into options trading: historical versus implied volatility. By the end of this video, you'll have a clear understanding of these concepts and how we can apply them to our trading. First, a quick refresher on what volatility is. Volatility measures the risk or uncertainty in the underlying stock. It indicates the magnitude of stock movements, but not the direction. This means a market can be volatile whether it's rising or falling. Consider two stocks starting the year at 100 rupees. The first stock, shown in black, has low volatility and trades around the 100 rupee range. The second stock, in blue, shows high volatility with more erratic and spaced out swings. Now, historical volatility is defined as the annualized standard deviation of past stock movements. In simpler terms, it measures how much the stock price has fluctuated daily over a one-year period. For example, stock A's 52-week range might be 45 to 55 rupees, indicating low volatility, while stock B's range might be 5 to 55 rupees, showing high volatility. Remember, historical volatility is measured in actual trading days, not calendar days. Typically, 30 days include around 21 trading days because the market doesn't trade on weekends. We can analyze historical volatility over short-term periods like 20, 50, or 90 trading days, or long-term periods such as 100, 180, or 250 trading days. These different time frames help traders understand volatility trends over those periods. Now, let's discuss implied volatility. Unlike historical volatility, implied volatility isn't based on past data. Instead, it predicts future volatility based on option prices. It's a forward-looking indicator reflecting market participants' expectations. Let's say a stock is trading at 50 rupees with an implied volatility of 20%. This means the stock is expected to move 20% or 10 rupees, either up or down, 68% of the time within the next year. Implied volatility captures market sentiment about future price movements. However, and this is the most important point, implied volatility is exactly what the name suggests. It is implied. Just because people are placing bets for a 20% volatility move does not necessarily mean that's what's going to happen. That's where bets are being placed. It's not the actual movement of the security, it's just market theory. At the income option, we use this theoretical value to create an edge for ourselves. We'll explore this in more detail in a later video. Now, we also need to know that higher trading volumes provide more accurate readings. Accordingly, it is better to avoid options with low volume, as they can give misleading implied volatility levels. So, to summarize, firstly, volatility measures the magnitude of stock movements. Then, we know that historical volatility is based on past stock price fluctuations. Implied volatility, on the other hand, predicts future movements based on option prices. We know that we have to focus on both short-term and long-term volatility trends. And finally, high trading volume provides more reliable volatility readings. Mastering both historical and implied volatility is crucial for successful options trading. I hope this video has made these concepts clearer. If you found this helpful, please share it with friends, family, or colleagues. Thanks for watching, and see you in the next video on the income option.